Good evening and welcome to Money Matters TV. I'm your host, Brian Kohute from HJ Wealth Management. My co-host is Jim McGrory from Drucker and Scaccetti, fellow CPA. Our special guest is Robert Bovarnick. He's an attorney from Bovarnick and Associates. We have a great show, so thanks for joining us. Jim, as we always caution the viewers, this show's taped. This one will probably be sometime in the summer, which is a great time to think about tax planning. Most people think you think about tax planning in January, but that's not correct, right?
That's correct, Brian. I would say not necessarily tax planning, but tax positioning is a good time to really get your tax records organized and see how your year is going. Because the worst thing you want to do is see your CPA next April and dump all this information on them, and you're basically your world has changed, and you're telling them this information, and they really don't have a lot of time to deal with issues that could have been dealt with in the prior year. It's a great time to really reflect and think about, has there been any changes in your life this year? So we're in the middle of 16. Did you get married? Did you get divorced? Did you have any children? And those types of questions where you do an inventory of where you are in life. Do you have kids going to college? Do you need to fund the 529 plan for them? Are you going to retire this year? Did you turn 70 and a half and you've got required minimum distributions you need to worry about? So again, it's your planning, positioning. You're really taking a look at your tax situation for the year.
Yeah, so it's a good point. So there's life events that happen. They buy a house, sell a house, got married, and they really should get an accountant involved in those conversations. Recently, around when it happened, most people start thinking when they get the tax forms, oh, right, I should let them know, or maybe you find out the hard way.
Right.
Why is it important to know ahead of time? Are there things you can do to help reduce the tax, maybe?
There are. For instance, if you just had your tax return done and you were very upset about, you got this, you had to owe, and it's like, well, why did you owe? Well, maybe your withholdings at your job are not high enough. So you would need to go to your payroll department and fill out a new W-4 and change your exemptions. Reverse of that is if you got too much a refund and basically you just gave the government an interest-free loan, you could increase your exemptions, and then that would basically reduce the withholding you had during the year, and so you wouldn't have as much a refund next year.
Now, some people like to force savings of a refund. Do you try to talk them out of that, or?
It all depends. It all depends. There's so many clients that feel that they would rather just pay the IRS just enough, and that is there are rules that you should have just enough paid in order to avoid estimated tax penalties. So you either have to have 90% of the current year tax paid in, or 100 to 110% of the prior year tax. So again, during the year, you could look at where you're going to be in that spectrum, and adjust your withholdings to get there. So you just have enough just paid in.
That's a really good point, because what I find a lot of times is clients might have had a really big income year, for one reason or another, and they know it's not going to persist that next year, but they're set up to pay estimates as if the income was going to be the same, because no one knows what their income is going to be, right? But at some point they could take a look with their account and say, hey, do I need to keep funding these estimates at this level because maybe I'm overpaying, right?
And it hurts cash flow. You're making the financial decisions where you're paying these estimates. You're maybe selling stocks to get the cash flow to fund these estimates, and you didn't have to fund them to begin with.
And you're compounding the problem, next year. So.
Another issue that we saw during this last tax season, and something that can be done during the year, is if you're making charitable contributions, you should be getting documentation for every contribution that you make. Whether if it's a small contribution under $250, you should at least have a check. There's no more charitable contributions for just taking money out of your pocket and putting it in the basket at church. You need documentation for that. Any contributions greater than $250, you should have a letter from the charity. The charity should say how much you gave, and there should be specific language in that letter that no goods or services were received in exchange for this contribution. Or if goods or services were received, say if you went to an auction and you bid on something, there should be a value of what you bought in essence, and then anything over that value would be deductible. But we saw a lot of cases where letters were just thank you for your contribution, but it didn't have that required language. And the IRS is very serious. They will deny those contributions on audit.
Is there a limit what you can take as a charitable deduction?
There are limits, Brian, and it's based on your adjusted gross income. So to the extent of certain contributions, you can deduct up to 50% of your AGI. Now, you'll have some individuals, they tithe. They tithe 10% of their income. There's no problem with that. To the extent that you cannot, you're over the adjusted gross income limit for a year, your charitable contributions get carried forward for 5 years. So they're not lost.
Right. And it would be a pretty large contribution to probably, unless you were in a very low income, but
Yeah.
that'd be harder to give a lot of money away.
Right? It is. It would be hard, but it happens. And that's another charitable contribution documentation rule, is if you give a charitable contribution greater than $5,000 of property, that property, you need a qualified appraiser to verify the value of that property, and there needs to be certain sign-offs on this form that needs to be attached to your tax return. So again, this is information that you should be getting during the year, not that you're in your accountant's office in March or April and telling them this information.
Right. The shoebox doesn't work when they.
Shoebox is a scary thing.
So investments, I think some, high income taxpayers got caught by some surprises because at a certain level, you can get into a pretty high tax bracket on your investments.
Yes.
There's a 3.8%, additional Medicare tax. There's a higher capital gains tax.
Yep.
Obviously, there's opportunities to plan around that as well.
Absolutely, absolutely. And what's interesting about that net investment income tax, the net investment income tax kicks in for single taxpayers. I think when their adjusted gross income hits $200,000. For married joint individuals, it's $250,000. It's almost like a cliff tax. Like once you are $1 over, you pay that tax. So if you could work with your financial advisor and say, well, maybe I should harvest losses this year, and basically you can manage your adjusted gross income, and it's an automatic 3.8% tax savings.
Right. And I think people say, well, that sounds like a lot of income, but you think of like New York, D.C., two income earners, you get it there relatively easily, and you're not rolling in the money, right? So
you get there very fast.
Yeah,
you get there very fast.
Great, good advice. So the mileage one is probably the big one, right? The IRS talk about charitable. I mean, this is one they really tried to clamp down on because people were abusing how much they drove for work, and that what do you tell clients they do? They really have to keep that log and maintain it?
Absolutely. And when you have a small business or you're self-employed, basically you have revenues, but your expenses, you need to have ordinary necessary expenses to generate that revenue. A key piece, though, is you need documentation and support, verification for the expenses you're incurring. If someone is using their car for business, not commuting to a job, but that you have to go out and see clients and you're using your car, you should be tracking your mileage. I think the mileage rate for 2016 is 54 cents a mile that you can in fact deduct, but you need logs of what your business miles, your personal miles. Again, you need that, and it needs to be contemporaneous. You should be keeping this log as you go along during the year. It can't be that you're sitting in an IRS office handling an audit and you
typing it up magically.
And you're typing up magically.
So,
yep.
I understand they relaxed the rules on the home office deduction. First off, do you see many people taking it? And then if they don't know what it is, maybe you can explain quickly what the home office deduction is. And I understand they might have relaxed what the requirements were.
The issue with the home office deduction is and you talk about the top 5 issues that you get audited for. Home office deduction is one of them. The issue with that is that the office needs to be used exclusively for your business. I've heard stories where on audit clients lost the deduction because they had baby toys and a crib in the office. That's where it gets silly almost. But so the IRS relaxed the rules, I think, with the 2014 year, where they base it on a square footage of the room, and they let you take a certain limit. It's very de minimis, but at least gives you some benefit or recognition that you have a home office.
Great, good. So, any other tax planning? Self-employed is probably a big one. Is there any, if someone works for themselves, any opportunities for them to do some tax planning?
I often find my self-employed individuals, it's always a shocker for them when I say, oh, you're self-employed, you've got self-employment income, you're able to make a retirement plan contribution. And they say, what do you mean? I said, well, one of the plans available to you is a SEP IRA plan. A SEP IRA plan is very easy to set up. There's a lot of the brokerage houses and banks possibly have prototypes where you can fund a SEP IRA and get a contribution deduction to that. It works out to be almost 20% of your self-employment income after self-employment tax. But there's another, I would say, even more robust solution, and it's called the solo 401k.
Right. Yeah.
A solo 401k is a type of plan that needs to be established before the end of the year, but the contributions you can make to the plan, depending upon how much self-employment income you have, could be significant. It could be up to $53,000.
Right. So unlike the SEP where you can establish it after the fact and fund it, but I think the solo 401k, it needs to be open, but it doesn't necessarily be funded before the end of the year, right?
That's correct. There's two components of the solo 401k. There's the employee component and the employer component. The employee component should be funded during the year. The employer component, you have up until the extended due date of your tax return, which could be October 15th.
Right.
So you can file, and in fact, you could extend your return, file it, get your refund, and then with your refund money, fund your 401k. So fund your 401k contribution.
This always confuses the business owner because I'm not the employee, but this is the time you wear both hats, right? You're the employee and the employer for yourself. So,
and if you do have employees, there are other plans you should consider. And you should talk really with a retirement plan advisor or financial advisor about that.
Right, yeah, because you may have to give money for other people, not just yourself if you have a full-time employee.
Correct.
So, great. I guess dependent care is a good deduction that people have advantage of. There always seems to be confusion around education credits. When do you take them? When don't you take them? Is it really a fact and circumstance situation?
Well, dependent care is it's a credit you can take. And for the most part, if you're a single individual with a child or children, or a married couple with children, and both individuals are working, you can, if you're paying after-school care or even summer day camp, not overnight camp, the cost of that, you can, up to some extent, you can get a credit for that. A lot of people don't realize that. The education credits are another area where if you have children attending college, it all depends upon your income level or your child's income level as far as who can claim a credit. But there's a refundable component and a non-refundable component, and you need to really work the numbers. Again, who should take the credit?
Right. So kind of a little plug for CPAs. A lot of people use software to do this. And like what I find, not being in the business of doing tax returns, sometimes the software doesn't always pick up all the different nuances of when to take it, maybe what's your best outcome, right? So there is some value sitting down with a CPA and doing the planning, at least part of it.
It is, because in fact, I do my personal taxes on a software program, and there's a question and answer component, and you could just, you're getting a cup of coffee or something like that, you're not paying attention to a question.
How you answer it.
And now how you answer it, it will lead you to other questions, and you may have completely missed the deduction.
Yeah, no, that's great. Jim, you have time for a question?
I do.
From a viewer. Betty Reynolds from Exton asked, you have any good tips for financial record keeping for small businesses?
I think it's a very good question. I think that the key tip in financial record keeping is to be organized. What you really need to do at a minimum is separate your records. You should have records that you have your tax returns. You should have records that are the supporting information for your tax returns. And then you should have records that are more or less considered permanent. So types of permanent records would be contracts, articles of incorporation, bylaws, things of that nature that will live on, and that you may need someday. Tax returns, I would recommend that you keep tax returns permanently. There's some schools of view that after a certain number of years, 7, 10, you could get get rid of your returns, I would prefer you keep them. All of the documentation, the supporting documentation for your tax returns, you can really dispose of them. I would shred it after 7 years.
Right. Good, great answer. Here's how you send your questions to Money Matters.
You can have your questions answered on Money Matters. Please go to our website, money-matterstv.com. On our homepage, click on the banner on the right that says Send Us Your Questions. While you're on our website, you can find information about our host and guests, as well as show notes and links about this show and past shows. Money Matters is also available as a podcast on iTunes and Stitcher, so you can listen to Money Matters while you're on the go. That website address, again, is money, M-O-N-E-Y, -matters, M-A-T-T-E-R-S, TV.com.
Welcome back to Money Matters. Now it's my pleasure to introduce our special guest, Robert Bovarnick, attorney. Welcome to the show, Robert. I know you've been on before, but remind our viewers of your expertise in the law.
Oh, Brian, Jim, it's great to be back. I've been on a number of times, and it's always a pleasure. I'm a business lawyer. I've had my own firm for about 12 years. Before that, I was at a large firm, and my practice encompasses all facets of business, from transactional work to litigation, to financial restructuring and business bankruptcies on behalf of companies and creditors.
So, a term that we hear a lot, because we all deal with businesses, is a MOA, or a memo of understanding. What is it?
Well, actually, before I get to that, I want to follow up on something that you just said. You were making a pitch to Jim about CPAs and using the QuickBooks or whatever it is online. I'm going to make a pitch for lawyers if I can, somewhat similar.
Yes.
And one of the things that a lot of lay people do is they will go online and they'll Google to get an agreement.
Right.
And frankly,
LLC, whatever
it is.
Yeah. So.
And the thing is, I do the same thing. The difference is, if the layperson does it, they aren't taking into account the differences between states.
Right.
So I use it as a place to start if it's something that I'm not familiar with. So while there's no problem with you as a layperson doing that, it's something that you should use when you would talk to your professional and say, this is as far as I've gotten, because one of the good things is you're going to help be a little more economical with your lawyer. It shows that you've done a little bit of your homework,
right,
and it shows that now you're not going to have to pay quite as much. So that's my pitch for lawyers, my pitch for CPAs.
It's a great point, because LLC seems to be the entity of choice, but that's not always probably the best choice for people, right?
Well, that's exactly a great point. As we were talking about before the show, there are a number of different things. I mean, it used to be you had C corporations, and then there was the sub S corporation, and then about 20 or so years ago, the LLC came into vogue, and then also different forms of partnerships. There was the old general partnership, and then there's a limited partnership, then there's a limited liability partnership, and then there's a limited liability limited partnership.
Right.
And unless you are familiar with those, you don't know what's going to be the right thing for you. And also, in certain states, you can't have everything. You need to be, you may need to be like a professional corporation. You can't be an LLC. So that's why it's important to always speak with your legal professional.
Mm-hmm.
That's good advice.
So to get to the question that you did raise,
so
letters of intent, memoranda of understanding, simply stated, what is that? It's an agreement to agree. And it used to be that somebody would call me up and they say, I'm doing this deal with so-and-so, here it is, do the contract. And the challenge was, if it was a large, sophisticated transaction, it would take a long time. So then what happens often is that you do, it's almost an outline.
Yeah.
So these are the general parameters of what we're going to do. One of the nice things about the LOI, and by the way, I should say, if you hear the term LOI, letter of intent, memorandum of understanding, MOU, there are a couple of cases out there that will distinguish between the two, but effectively they're the exact same thing. Again, just think of it as agreement to agree. And one of the things that you're going to want to do is you're going to want to say, if you want, that it's non-binding. And we'll get into this in a couple of minutes as to, is non-binding really non-binding, but that gives you an out. But one of the nice things is I have a lot of clients that will send me an LOI that has been signed by both parties, and they're using that as the framework for the agreement. And so what I then do is I will take that and turn that into an agreement. And as I said, while it used to be, this was something that was used for large agreements, not anymore. I have one client who just a week ago was hiring an independent contractor. So he and this fellow had an LOI with respect to the terms of the independent contractor agreement. He sent it to me, and then I took that and I turned it into, it was a very short agreement. But
Right.
I had the basic terms, and what I found as I was going through the terms that the two of them had laid out, there were some nuances that needed to be discussed. So that's a good thing. And again, it certainly sped up the process for them, and it reduced the cost for the client. So that's in essence what it is.
Nice.
How about that? No, I'm almost imagining if I would come to you, Rob, and I have this letter of intent or memorandum of understanding, and we signed it, my counterpart, we brought it to you, and you basically say this isn't correct, you need to make changes.
Well,
now does that mess things up?
not at all.
No, okay.
It clarifies things.
Okay.
Because I recognize that you're not a lawyer. That's not your
Right.
day job. And so there are only certain things that you have. However, you're the businessman. You're the one who's saying, these are the primary business points that we want to do.
Right.
Now you, Mr. Lawyer, you turn that into a legal document. Now, what I will say is if you are going to do that as the business person, one of the things, there are a couple of key points. Say it's non-binding,
Right.
and that way you have an out. And also, don't call it an agreement. Call it an LOI, call it an MOU, because, of course, every time you enter into a transaction with somebody, it's one big happy family. Nothing is ever going to go wrong.
Right.
My job
Until it
is
goes
to
wrong.
say, what happens if things go wrong?
Right.
And so one of the things that you want to be in a position, if things go awry and you no longer want to do the deal, and we'll talk about some examples of that shortly, you don't want the court to sit there and say, well, Jim, it looks like it really was an agreement.
Right.
And so you want to make sure you keep out certain buzzwords. Keep in the buzzwords of non-binding. Keep out the buzzwords of agreement. And even things that are that will appear as boilerplate language in a contract, such as if you want to waive a jury trial, which happens often. Don't put that into the LOI, because you don't want it to look like it's a full formalized agreement. You want it to look like, hey, this is step one in our process. So
This is sort of a template of how we want to behave.
that's exactly right.
Yeah.
And one of the things that you have to understand is things can happen from the time that you start the process until the time that you finish the process. I'll give you a great example. Last year I was involved in a transaction where my client was buying an entertainment company. And so one of the things that we had in the LOI was we had language regarding due diligence, but it was a number of stages of due diligence. For that particular situation, we had financial due diligence and we had operational due diligence. Now, obviously, the client, through his financial professionals, needed to go in and make sure that the numbers were what the seller said they were. And then from the standpoint of the operations, since it was entertainment business, we needed to go through all the contracts to make sure that the talent was going to be there, because it's one thing to buy this really nice entertainment company. If it has no talent,
Yeah,
then what good is it?
Right.
So those are the things that you want to look for. Another thing that I think is important that I don't see too often is if you have an automatic termination date. Say, in other words, let's get this done. If it's not what's today, it's the middle of summer. So let's say if we don't have it done by Labor Day, then it automatically terminates.
Oh.
So that's another thing to keep in mind, because again, the goal here is to have this look like it's something that's not a permanent agreement.
Right.
Would your preference, I think the answer would be yes, is you would see the LOI before your client actually signed it, rather than them handing you a signed one?
Right.
That would be preferable, but it isn't. It isn't fatal.
Okay.
I'll give you another example. I have another client recently who part of the deal was they were getting money and a piece of the other entity. And as they started doing the process, it realized that the finances weren't going to work. And so what we said is, look, we need to renegotiate some of the financial aspects of the transaction. So even though the numbers were in the original LOI, because the parties agreed that things were playing out a little differently than anticipated, that it made sense to go ahead and renegotiate that very important term.
When does non-binding become binding?
You mentioned that. You mentioned non-binding.
All right, I will say, ask Ted Turner. Now let me tell you what happened to old Ted a number of years ago. So a number of years ago, Ted Turner was selling. It was the Atlanta Thrashers and some other sports team down Atlanta. Enters into an LOI with the people that are going to buy it for $281 million. The contract said it's non-binding until there's a full and final negotiated agreement, which is what I was having all in mind. But the parties continued to operate as if there was a deal, and in fact, there were some public pronouncements that the deal was done.
Right.
So before the deal got done, there was an opportunity for Turner to sell it to a third party at a better price.
Right.
So he goes and enters into the contract to sell it for a higher price.
An actual contract.
An actual contract.
Right.
There is now a lawsuit. And even though the only thing that the first guy had was a non-binding memorandum of understanding, the court said because of the way the parties acted, they acted as if it was a full contract. The amount of judgment, $281 million. So that's that. So the bottom line is, it depends on what's in the contract, and it depends on how you act while you're in the LOI. Excuse me. And, I apologize.
Yeah.
And it depends on how you're acting during the process. Another example: there are LOIs and MOUs for large leases, and a lot of times what you have is you have virtually every single important term in the LOI. Well, what's left to do before you get the lease? So that even though it says non-binding, you effectively have agreed on everything, and so that way the court is inclined to say, well, you really did have an agreement. You look at the intent of the parties is really what the courts are looking at.
Right.
So we have a few seconds left. Anything else you want to share, Robert, with the viewers?
It's everything that you do with respect to your business and your attorney. It's important. And originally, the first time I lectured on this, which was the spring of this past year, I was thinking, it's an LOI. It's not that big of a deal. It is a big deal.
Yeah.
Everything that you do with respect to your business, it may not seem like a big deal. It can turn into a big deal. So you need to be careful. You need to pay attention to all of the nuances, all of the little bits and pieces of it, and make sure that you go through all of the facts with your lawyer. That would be my best advice.
That's great advice.
That's great advice.
And obviously the theme here is we have CPAs, we have attorneys. They're here to help you. So you really want to get your advisors involved, especially when there's any change, any significant transaction being contemplated or executed. Really, right?
It's interesting.
And watch doing it yourself.
Well, just remember the Purolator oil filter commercial from when we were kids. I remember the tagline, right? You can pay me now, or you can pay me later. Right. So what you do is you want to talk to Jim during the course of the year and not wait until you either give him that shoebox worth of documents or you get that audit letter. Talk to him, spend a little bit of money now and not the big amount of money down the road.
Great show. Great advice. Please join us next week. Our special guest is Barbara Shaman. Embrace your legacy now. Please join us because your money matters. Thank you.